These are in listen-only mode.
Well, good morning, good afternoon, and hopefully it's not good evening and good night for wherever you are. This is Dan Henn, CPA, with Jason Bowman. Welcome, Jason.
Thank you, thank you.
Well, today I'm going to be the driver, and hopefully, again, I don't attest to all of the polling questions, so Jason is the caretaker of that. But when it comes to the material today, hopefully you guys will get a lot of good information to help you take the next step, and hopefully this will be something that will, again, continue to help give you more knowledge how to deal with these types of clients who just have a lot of issues, and it starts to become a little more second nature as you start dealing with this. And not only that, but it just helps you overall in understanding how the whole process goes and how to work with the IRS. Any opening comments you'd like to make on top of that, Jason?
No, I just realized that with me driving the slides, that might make it more difficult for you. Did you already have the slides up on your side, or did you just tell me next slide and
yeah, I'll just tell you next slide. That's fine.
Okay. Cool.
So go ahead and we'll get rolling here. And then just out there, if you guys would just post, again, where you are, what's the temperature like there, just let us know that you're hearing us loud and clear. Hopefully everybody got to download the handouts. There were links in there in the email that came out, also as well as it should be in the handout section under the, whatever they call that, GoToWebinar bar there.
Yeah, on the
okay,
handouts
thank
page.
you, Teresa from Detroit, Michigan. You don't know what the temperature is, I'm assuming, with the question mark there. 76 in Houston. Hopefully you guys are still breathing after that game last week. Southern California and Amit with 55 degrees. And then Edward in Miami is warmer than us at 77. So let's talk about the collection financial standards. So ultimately, by the end of the session here for the next hour and 20 minutes or so that we have, that we're going to help you understand what collection financial standards are, explain some additional individual expense categories, how to apply them, what it is, what's the ultimate purpose of the Form 433. And we generally speak in terms of the 433A here, but we will briefly mention the 433B, the 433F, and the 433D, and how they all kind of play into the situation here. And then at the end here, we're going to talk about the income and expense table. So don't forget here, go ahead and go to the next slide there, Jason. We will talk a little bit as we can in regards to our friend Randy that we mentioned to you guys last week. Remember, he's a full-time realtor. He averages about 12 transactions a year, and divorced with a teenage son. So make sure you pay attention to the facts of what we've got here. And go ahead and next slide. Here's Randy's financial information and how this kind of portrays or relays into the various aspects of how we go through and prepare the Form 433. And then finally, the last slide is his wife, Heather, or I should say ex-wife, who then, remember, she married a circus clown and hasn't been making child support payments. And this is where, again, pay attention to some of these key facts, and we'll come back to this because I'll ask you some questions to see when we get to the end how you guys would play and do some of these things as we learn some of this stuff. So, next slide. So last week,
it's time for a polling question.
Oh, you're not the circus clown that Heather married, was it, Jason?
I don't think I'd want anything to do with that situation.
Okay. So let's answer the first polling question here, everyone. Again, we do the best we can to try and make this as entertaining as possible. Hopefully, if it's entertaining, you'll pay attention. Because this is good information and stuff we want you to do. So, so 2 times 3 equals, just select one. You just got to answer. Remember, if you want to get the credit, how many questions do we have, Jason? And how Can you give the folks the rundown on that?
For CPAs, our goal is to be here for an hour and a half. So CPAs, if you answer 5 of the polling questions, you'll get an hour and a half. Enrolled agents, we cannot earn half-hour increments. So as long as you answer 3 questions, you'll get your full hour of credit as well. So.
Okay.
All right, I'm going to go ahead and close the poll down. If you need to get a vote in, make sure you hit that submit button. Just in case anybody's curious, the leading response right now is 1. 1 is our current leading response. But
actually, the interesting part of this is which one is everybody actually inputting. So.
Over half of everybody picked the first 1. So 2 times 3 equals 1, and that's why I'm in tax, not an accountant. All right.
Yeah. Okay, so moving on, next slide. So we're going to, hold on one second, please. I was looking at the wrong slideshow here. So, purpose and application of the collection financial standards. So ultimately, at the end of the day, guys, somebody type this in the chat box. Please let us know why do we have to go through this process? What are we trying to determine here at the end of the day with these financial standards? We kind of talked about it a little bit last week with why are we trying to gather all this information on Randy and put this stuff together. At the end of the day, what are we trying to determine for, in this case, Randy? Anybody have an idea?
This is the audience participation part of the show.
Yeah.
Diane,
you got it. To determine if he can pay.
Yeah.
So next line. So the purpose, obviously, is to determine a taxpayer's ability to, in this case, repay, because they haven't paid anything yet. So we're going through the analysis to see what kind of assets, liabilities, income and expenses, and how we get that reported to the IRS, and hopefully in the favor of our clients. But ultimately, again, at the end of the day, it is what it is. But there are some things that you can play with, and we'll talk about that. So now, when we go through this, what we're doing here is differentiating between necessary and unnecessary living expenses. And so what we as general public determine as necessary and unnecessary living expenses, as we go through this, you will see that the IRS's definition of necessary and unnecessary is not the same. And the numbers that we'll be talking about are designed around a middle-class lifestyle. And obviously, again, just like when you hear the term small business, everybody has a different definition of what middle class is. So we will go through that, and you'll find how this is very restrictive for certain people in certain places. For somebody like Amit, who's actually in California, or Brian there in New York, you guys are, there'll be certain things that you will have a little bit higher than some of the rest of us because of being in a higher income area. But you'll be surprised on how this works. But now, these numbers too are also updated and reviewed quarterly, but they're not necessarily always changed. Before this session, we looked at and made sure we updated it, because last year when we did the training, we had the 2015 numbers, and they changed them in March of 2016. So as of today, that I'm aware of, they have not updated the financial standards that we'll be talking about, so they are still the same that have been since March of 2016. But always be aware of that and when they change, because 15 to 16, the numbers actually went down.
Yeah.
So I think it was around 8%.
Yeah, 9%, pretty much across the board. It was pretty bizarre.
Okay. Okay. So next slide. Okay. So what the financial standards are intended the standards are intended to cover the basic living expenses, okay, and nothing more. So you'd be surprised a few things of what they actually cover or include as living expenses, but you'll be surprised at some of the things that don't. But we'll give you a few little tips and tricks that might play out better for you as we go through this. Now, the service may allow for actual expenses in certain situations. For example, I had a case recently where I had a guy, he's paying for a lot of expenses for his, he's got two twin boys who just happened to turn 16, and he's got a big healthy insurance bill that he has to pay for them. And I tried to submit it, and the revenue officer wouldn't accept it. So, you know, I mean, there are certain things you have to try and see if you can do. Worst thing that they could do is say no. And then, of course, you're going to come across people who are living significantly beyond the standards that they're going to need to downsize their lifestyle in order to get the type of situation that's really going to help them financially. Although at the same time, if they get rid of some of this crap, you know, if they're trying to keep up with the Joneses and have that nice car where they're leasing, you know, get rid of the car, get rid of the lease, and sell some things, downsize their house. Unfortunately, these are going to be some difficult questions and conversations you're going to have with your clients, because you know, some people are just not going to want to do that, and eventually you just got to tell them, well, if you don't, more than likely you're going to have liens, and then eventually, if you don't deal with it, they're going to start levying bank accounts, coming after wages or any other income source. You know, they'll come after your 1099 income. They'll go after your clients and your your accounts receivable list. So, you know, they can force the sale of equipment and other things. So you got to play ball with them. So hopefully you can have people who will be cooperative with you. Any comments you have in regards to that, Jason?
Of course I do. I tell people that they're going to have a come to Jesus moment with their clients. And I know that phrase is probably offensive to you, sorry. But
no, that's okay. I get it too.
you got to have that difficult conversation where you say, now looky here. Instead of keeping up with the Joneses, think more along the lines of keeping up with the Clampetts. Okay? That's what we're aiming for. And if you don't get that joke, then, well, maybe that just shows how old I am. So.
Yeah, well, you know.
Beverly Hillbillies, that was their reference.
Right. Yeah, well, you know, they didn't really even care to spend their money. They'd rather still go around in the jalopy. So.
Exactly.
Yes.
Before the oil. Before the oil, George.
Yes, before the oil. Go ahead and go to the next slide there, Jason. So. Now, these are some things that we're going to talk about here for just a couple minutes, and say that, you know, it's hard to use the term never and always, because these are things that at first glance they're in most cases are not going to be allowed, but there's a few of them here that have some caveats. So, for example, private school tuition is not going to be allowed. You know, sorry that little Johnny's going to Catholic school and, you know, he's a part of the sports program there, but, you know, you can still pay for it. It's just that they're not going to give you the deduction for it in terms of the analysis that we're going to look at here coming up shortly. Higher education. Now, actually, let me go back to the private school. The only instance that, and I think, Jason, you said you had a case where this might have happened, where if you have somebody who might be a special needs child and the public school system can't accommodate them correctly, that may be a case where allowing a private school tuition may be allowable. But again, a lot of the things you're going to have to do, and just like with tax returns, I tell people, as long as you keep the proper documentation and can prove it, now obviously getting them to agree on that, but if you can document it and prove it, then that's going to make your effort a lot easier. Same thing with higher education. Now, when you come to the higher education, and again, I think, Jason, I don't know if you want to talk about, I think you had a case in regards to the higher education where you did get it allowed.
Yeah. So here's the bottom line on pretty much all of these, is that like Dan said, the word never probably shouldn't even be on the screen, but these are called conditional expenses, not basic necessary expenses for life. But the two buckets that really the IRS pays attention to for allowing these kind of conditional expenses has to do with two things. One is the creation of income. If the expense is somehow related to the creation of income, that implies that it's income that can help pay off the tax liability, and so they might consider allowing it. The other is this broad category of health and welfare of the family. Okay, so for example, a special needs child that has to go to a private school to accommodate their disability. Something that you're seeing more and more these days is kids that are victims of bullying, or if they're LGBT students that are facing a lot of difficulty in their public school, and they're going to private school so that they don't get the snot beat out of them every day, okay, saving the kid's life probably, then that's something that you can make an argument for, right? But that's health and well-being of the family. So that's the big thing with these.
Right. And then the case that Jason you had previously said about the higher education, that in general they're not going to allow it. However, he had a case where the kid was in their senior year.
Senior year, yeah.
And I think the term you used is don't let the child pay for the sins of the father.
Correct.
And not being able to graduate if dad can't afford to pay or can't continue to pay for the tuition.
Right. So I made the argument that allowing the parents to pay for the final year of college was in the best interest of everybody, including future, the future earning potential of the child and that person becoming a tax-paying person, right? So by making that argument and saying, look, yeah, like Dan said, don't make the son pay for the sins of the father, I actually got that argument through. Now, if it's a freshman or sophomore, especially at an expensive private school, I don't think that's gonna fly. But senior year at a state school, I've done it once, so.
Yeah, well, I mean, again, here you're getting the kid off the payroll, so that hopefully the next year there's no more tuition books. And trust me, I'm there right now, so I know what it costs to do that.
You're getting the double whammy right now.
And like you said, adding another person to the tax rolls is always beneficial too. Now, note that in the tithing, being a Christian myself, and I tithe, and but for me, as just a general tax-paying person, they're not going to allow that. The tithing, they're not going to allow the charitable contributions. But if I were a pastor or a member of the clergy, and it's a requirement of my employment, then that is a different situation. That goes back to what Jason said about the production of income. So, if I don't tithe, I could lose my job. And if I lose my job, well, then the IRS is definitely not going to get their money.
Right.
So that's where it's in the best interest of everybody that person would continue to do their tithing. And again, same thing for the charitable contributions. Now, retirement contributions, when they're elective contributions, so such as a 401k, IRA, those types of things, a SEP, again, those are not going to be something that's going to be allowed. They're not going to want you to set up for your future if you're not dealing with the current and the past stuff. Right. And then, of course, any payments on unsecured debts, that is generally what was not allowable previously. Now that moves us down to the to the bottom over there, where it says that as of 2012, with the Fresh Start campaign, the minimum credit card payments and minimum student loan payments have been permitted in the Offer and Compromise. That's what OIC stands for. Offer and Compromise, and RCP is Reasonable Collection Potential. We will talk briefly about that today, but that whole part is really a 2-hour course in and of itself, which we move to. Where is that, Jason? Level 2, level 3 that we talk about.
Yeah.
Yeah, level 2 is the next course. And then everything that we're kind of referencing here, just look at publication 1854 if you'd like to see further details on that. So, next slide.
Blank. That means
another polling question.
Da, 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 da. How do you keep a bull from charging?
And Jason, Donald had a question there about recordings for this. Are we going to have those available for them?
Yeah, so at the end of the series, we'll send out an email that contains all the recordings.
Okay.
So so after next Fridays, we'll send those out all in one. Yes, these are the same polling questions from last week.
Yes, Stuart. Unfortunately, there's no requirement that the polling questions actually have to change. They just have to know that you have to answer them. That just shows that you were here to be able to get your continuing education credit.
James, good questions. What about student loan payments?
James,
oh, go ahead.
Yeah, James asked the question, what about student loan payments for a daughter that the parents guaranteed the daughter cannot work because she has diabetes? You want to take that one, Jason?
So student loan payments, if they are federally guaranteed, if they're federal student loans, then you're going to put those on the income and expense table. If they are private student loans, then the majority of cases, those are not going to be allowable.
Okay.
Because they're unsecured,
so,
and they're not. Right. It's unsecured, and it's not a government debt. So,
but in this case, because the parents guaranteed it, and assuming that they're federal government loans, then yes, then I would include that as part of the analysis.
Yeah, if they're federal loans, you're going to throw them in there. All right, I'm going to close the polling question. How do you keep a bull from charging? Okay. Take away its credit card, or tease it with a laser pointer.
Okay, so now we're going to talk about the basic parts of the form, and then we will end by looking at the form and how these parts translate. So the first part of the national standards is the category of food, clothing, healthcare, and other miscellaneous. When you look at that, this category, as it says there, includes food, housekeeping, clothing and maintenance, personal care products, miscellaneous, if you do haircuts and anything that kind of personal care, those types of things. But what this allows is a maximum amount. So if you have one individual, and these are national, these are not different because you live in New York or California, unfortunately. So here in Florida, my client has to deal with the same thing that Amit and I forget who that was in New York, but you guys we all have to deal with the same numbers that you're seeing on the screen. Now there is a number for 2 and there's a number for 3, and then there's a number obviously once you get over 4, but you can see the difference between one person and each additional person. Now, in general, there's supposed to be some savings by having an additional person, although I don't think you would agree if you would say that you have a teenage boy in your house. So this is one of those things where most people will probably say they don't look, that it doesn't look fair, especially when you get to 4 people and it's $1,500 when one person is $570. The math just doesn't seem like it works in that regard. So this is where this is the unfortunate aspect of this, but again, this is what it is. If you spend more than this, you get to take this. If you spend less than this, you get to take this. So whatever the number is that applies, and there's a chart available, and for anything that we're talking about here, guys, if you just type IRS collection financial standards in Google, you will get the IRS webpage that has all of this stuff listed, and they have it all simplified in one long page, each little category that we're going through. So if you click the link to this, it will take you to a sub-page that will give you a little bit more detail and tell you what the current numbers are on that. Anything you want to add on in regards to this category, Jason?
Yeah, I just want to say real quick, in the miscellaneous section, that is technically where the IRS says that your minimum credit card payments fall. So under the Fresh Start initiative, where they're saying, oh, we're going to let you take the credit cards and those student loan payments, well, this is where it's supposed to be kind of lumped in with, which for some people are going to look at that and go, what? But yeah, that's where your credit cards are supposed to go. And to answer Diane's question, yes, these are monthly amounts. All of the national and local standards are based on monthly amounts. Eileen asked, will I get a copy of the presentation? You can download the slides in the handouts pane here on GoToWebinar. Also, an email was sent yesterday and this morning that contained a link to those. Check your spam folder if you didn't see the link. But yeah, keep in mind the big thing, the minimum credit card payments, that catches people, because a lot of people that owe tax dollars also owe everybody else in the world money, right? And so their minimum credit card payments could be fairly substantial, in the hundreds of dollars per month for their minimum payments. And technically it's supposed to be wrapped up into this particular standard.
Okay. And what about Christine's question about somebody out of the country?
So if we could spend an hour talking about that, sorry, we're going to skip that for now. That gets very complicated.
Okay. Okay. So let's then move to the next slide. Now, healthcare is a whole nother separate category. This is one of those where it gets to play into your favor a little bit. So if you have somebody, say, who's sickly and has higher costs in regards to healthcare, you get to take those actual numbers. So, for example, if you have an actual out-of-pocket cost and the out-of-pocket for doctors for copays or for prescriptions, and it totals $800, well, then you get to put this. Now, if you're a healthy person, general healthy person like me and my family are, that we've been very fortunate and blessed with that, you get to take a minimum amount, and you get to take $54 per person, and if anybody is over 65, then you get to take $130. So they give you a little bit extra there, because hopefully knowing that most people will get, when you get over there, you get over that age, unfortunately things start to wear and tear and break down a little bit more. And then when it comes to health insurance premiums, they are what they are. So I've been fortunate in that case where I've been having a streamlined installment agreement, which we'll talk about next week as far as the details. But in regards to reporting, I didn't have to submit. I had a gentleman who was under $50,000. We didn't have to submit all the detail, but they did ask me to send them a copy of an invoice for the health insurance premiums so that they could prove what that I was saying what they are. I mean, they shouldn't be surprised by health insurance premiums. I had a couple come in here, I think it was just yesterday or Wednesday, that their health insurance premiums for the two of them was $1,200 a month. I'm sure that's where mine would have been had I not done something different. But anyway, this is one of those categories where you just need to know how many people are in the house, who's paying the health insurance, where and how much is being paid for each member of the household. Okay, and again, any other questions you want to add or comments, Jason?
Nope.
Okay. So moving on, the next category, or I should say, I guess the next polling question, right? Or you want to?
Nah, keep going. We just did one.
Okay. Okay. So the next category is housing, utilities, and transportation. And again, this is one of those where it does totally can come to be unfair. And again, keep in mind that these are all in regards to, when we show you the numbers, the middle class lifestyle. Now, this includes rent and or the mortgage, the PITI, the principal, interest, taxes, and insurance is what that stands for if you've never seen that before. Includes maintenance, gas, electric, water, garbage, home phone, cell phone, cable TV, and internet. This is a very excuse me, a very large category, what's really interesting, and Jason and I have talked about this before, is that if you notice that last bullet point and at the very end, cable TV and internet are considered a necessary living expense by the government nowadays, so they do get to include that. However, what you're going to probably find in most people, their rent or mortgage payment is usually going to be the thing that takes up 90%, if not more than what's allowable for a person or a family of however many people. So you want to add any further comments in regards to that?
Oh, I could, but I won't. I'll keep my snark to myself.
Okay. Well, enjoy that, folks. He doesn't do that often.
I do not.
Okay, next slide. Now, remember the information here is compiled from U.S. Census Bureau, American Community Survey, Bureau of Labor Statistics, and again, as I mentioned to you guys earlier, that the 2016 localities, the numbers that we're going to show you here shortly, were decreased from 2015. And again, just a reminder that it's designed around a median income lifestyle, middle class type lifestyle. So so hold on to your hats, and we'll show you this next chart. And why don't you go show that next slide there, Jason? So as you can see on the screen, everyone, Brevard County is where I am located, and for me, as a family of 4, I'm allowed $1,802 for everything that I just showed you in the 2 previous slides before, where we talked about that this includes your rent, your mortgage, the maintenance, electric, all the other utilities. Edward, yes, that would include HBO, but it's all included in this number. Broward County is down south of me. Hillsborough County is in Tampa. King County is Seattle, near where Jason is. Kitsap, that's where you are, Jason, Kitsap County?
Yep, that's where I live.
Yeah, so he's in Kitsap County. Now notice the difference for Jason and Kitsap County. It's $2,298 for a family of 4 compared to me for a family of 4 of $1,802. Now, what I want to show you also is take it one step further. Let's go to the next column. What does the next column say? It says 5 or more. Okay, now remember how we talked about the food, and the food, there was an extra $341 for each additional person, so if there was a family of 10, you can take the family of 4 and then add I think it was $341 for each person on top of that. In this case, if you've got the family of 10, then for me at $1,831 is the most that they can take. Okay? Now, again, it's not to say that you can't try and ask and see about getting it done, but generally they're going to stick to these amounts. Right. So again, most of you will probably look at this and think that that's unfair. You know, again, look at where Kitsap, Jason, is for $2,298, where Seattle is in King County at $2,857. But if you look down in Florida here, Miami-Dade County, where Miami is, that's $2,290. So again, we have a lower cost of living here. So this does kind of factor that in. And those for you out west, this is Orange County, Florida, not California. So right. Don't panic if that's where you were looking at that. So that's where Orlando is here in Florida, not where LA is in California. So just be aware that these are the maximums that you can take. So when you, again, go through the analysis and see that you've got a person and their mortgage payment already exceeds the standard, then it doesn't matter what anything else they have. Right. Now, if there's reasonings, like I had a guy, I mean, I didn't run this, we didn't have to go through and deal with the IRS in this regard, but I had a guy who had a medical condition that required him to have his air conditioning here in Florida in his house or apartment always at like 66. Ouch. And if you don't have an energy efficient AC unit, his electric bill, I want to say, was in the hundreds. I want to say it was maybe like $500 or $600 a month. Wow. For his electric bill. That may be something that if I had that type of a client, I would go and try and see if I could add to that, because that's not normal.
Right.
So, this is supposed to look at the normal lifestyle of a person, a family of 4, family of 5, family of 1, whatever it is. So just be aware of that. Did you have any other comments you want to add in regards to this chart, Jason?
Yeah, so 3 things. Basically related to the conditional expense side. So again, this is a standard where you're allowed to take the lesser of your actual expenses, or if your expenses exceed these standards, then you can only take the cap, okay? But some considerations. I can tell you for a fact that in most of King County, finding an apartment for one for less than $2,000 a month is a huge challenge, okay? Huge challenge. I know plenty of people that pay $1,800 a month for a studio in Seattle, okay? Because our rents have skyrocketed. And then you have utilities on top of that, okay? So you could go to a revenue officer or an offer examiner, etc., and say, look, this is the absolute most affordable housing that exists. I can't find anything cheaper, okay? And then you have a conversation about conditional expenses. Next thing is also related to the cap. Let's say that you have a special needs child that needs, maybe a wheelchair ramp, or needs an entire special room that's basically like a hospital room, or something like that. Well, you may need to find a bigger house or a more expensive house than would normally fall under these standards. That is an argument to make for exceeding them. Another thing, and this is hitting close to home, the cold snaps we've been having here in the Northwest, don't forget that there are houses that still use home heating oil, which is the same thing as diesel fuel, I found out. But especially here in the Northwest and up in the Northeast. And so if I was heating my entire house right now using the actual oil furnace, which I've chosen to simply turn off, I would be spending $500 or $600 a month just keeping the house at about 66, 67. Okay, and and if that's your only source of heat, well, then an argument could be made for exceeding the standards for the winter months, not the summer, obviously, in this case, but for the winter months. So those are just some examples to show you where you can try making an argument to exceed these. Had some questions. Are payments for tax advice included? No. Does the $570 for the food, clothing, miscellaneous have to be substantiated? No. You could take the $570 regardless of what you actually spend. So if you spend less, you can claim the $570.
That's always nice.
Yeah, exactly. Are these OIC standards or also for payment plans? Both. Use the exact same financial standards for calculating reasonable collection potential for an OIC as you do for a payment plan. And then what if you're upside down on your house? Doesn't have any impact whatsoever on your monthly cash flow. Okay, that's an equity position problem. Doesn't come into bear here.
Right. And we'll talk about that in a little bit, Rich, in regards to being upside down and how that can affect the whole kit and caboodle. But just wanted to show you what these look like. Again, go to IRS Collection Financial Standards in Google, and you can see what it is for your particular area. When you click in the housing, it shows you a map of the U.S., and you click the state you're in, or no, actually it gives you a list of the states. Click the state you're in, and it'll give you the chart for your whole state by county. Again, this is the most commonly exceeded standard. I mean, it's easy. Most of you are probably scratching your heads just thinking on yourself how close you would be if you added your mortgage payment and all the utilities, and most of you are probably already exceeding that unless you just don't have a mortgage. Then that's one of the things that's going to cause you to be much less. And again, this is one of those things where people just think it's unfair, but unfortunately it's the system we have to live with. But that doesn't mean that you can't try and push and ask, and if you can come up with a argument or a suggestion that, like Jason said in a few cases, or like the one I said with the guy who has a medical condition, then that might be something that you push for. Now, there's what's called the 12-month adjustment period, which that gives you time, or your taxpayer client time, to readjust. So if they're living like they're kings when they really make money like paupers, and they're not being able to keep everything, keep up with everything, and so the taxes is the thing that they're not keeping up with, which is allowing them to afford the lifestyle that they have. So then what that allows them to do is trying to sell things, like sell the house, get to a smaller house, get to cheaper cars, do certain things where they can start minimizing their expenses to free up some cash flow, and then we can reevaluate it again and see if we can come up with a reasonable number that they can really afford to pay. Because again, right now they're going to be in a situation where you can't squeeze blood from a turnip, but the IRS doesn't care. You're being able to pay that and afford that, and so the IRS says, hey, you've got to start paying us, and the way you're going to do that is by changing your lifestyle. So you want to add any comments about that, Jason?
Yeah, the majority of time when you're doing the 12-month lifestyle adjustment, the taxpayer is placed into a de facto short-term non-collectible status. Most of the time they're not actually making payments. Sometimes they'll be required to, but the majority of the time they're not making payments. The problem with the 12 months is that month 10 rolls around and the taxpayer hasn't done jack diddly squat to impact their finances or their situation, right? So when you go this route with a client, first of all, make sure that they pay you a retainer or a monitoring fee or of some sort. Make sure you get paid for having your power of attorney active, because you want to keep your power of attorney active during this 12-month adjustment period, and you want to maintain frequent communication with the client. Don't just let them go off on their own, because now you got them into this year of leeway, right? So you've got to keep on the client and continue pushing them to actually make the lifestyle adjustment. But make sure you get paid for it. So.
Right. Yeah. Get paid for it. Make sure that this is where, if you've got a staff person, just have them periodically touch base with them, and then every so often, make every third or fourth call that's going to be made. You make that call and just touch base with them, seeing how things are going. Because unfortunately, a lot of people will just be out of sight, out of mind, and always let them know that, again, more than likely the lien is definitely going to be filed at this point for having to get into the currently non-collectible status. And also keep in mind that when they're in a currently non-collectible status, the 10-year clock that we talked about last week continues to run. But they've got to start making the moves, because if they don't, and the IRS still sees the agent or person you're dealing with, they always have the recourse of levying bank accounts and forcing sale of things, or coming after your wages, whatever the case may be, and you definitely don't want to do that. So now, moving on. The next aspect of this is the transportation standards. Now, for those of you in bigger cities with better public transportation, then you can take a number for public transportation or a car, but you can't do both. So if you got a guy who normally goes around by public transportation, and he pays for that, but he also has a car and just doesn't use the car, unfortunately you can't do both. And unfortunately, if you have a very good taxpayer who's smart and has a car that they don't owe anything on, then they don't get to take the ownership aspect of things. They only get to take the operating costs. So here's how this breaks down. For the person who's taking the public transit, that's $173 a month nationwide. So whether you're in New York or Paducah, Kentucky, in LA, or Cheyenne, Wyoming, it's $173 to pay for the public transportation. Now, ownership costs. This is, you actually own the car. So if you own one car, it's $471. It's $942 for the second car. What happens with the third and fourth car for a family? Well, the answer is nothing. That's it. They allow for 2 cars. So if you have a family with teenagers and they each have a car to get around, they're not going to allow for the extra car. And as we said before, yeah, it's very unfortunate, and it can be. I'm working on a guy right now that his one car that he has, on top of many other cars that he has, is a $800 and something lease, Mercedes lease that he has. So, telling him that, he's only got $471 that we can work with is going to be a problem. So
what's the exception to this rule, though?
Well, the exception to this rule is along the lines that Jason talked about with the production of income or health and welfare before. So if these are necessities for somebody to go earn income, so then they may allow more money or possibly even an extra car if you have that type of situation, right? Is that what you're getting at?
Yeah, so if they have a third car that they use only to produce income, such as a Uber driver, then that third vehicle could, because it's for production of income, you can get the allowance for that. Or think of, if somebody's in a wheelchair and they require a cargo van to get around, and that's the third vehicle, well, then you can get credit for that because it's required for health and well-being of the family.
Okay. Now, again, take a look at these numbers here. Now, that's ownership costs. This is you actually own the car.
Or lease it.
And you actually owe something on the car.
Yeah.
So what this really means is that if you have a loan on the car, then you get to take these numbers. Because remember how it says up at the top, if it's free and clear, you don't owe anything on it, then you get a big goose egg for these. They allow you the operating costs, which is below. So the South region where I'm located, it's basically $220 for each car that you have up to the limit of 2. And know that there are certain areas, like here in Florida, the Miami metro area gets more. But take a look at the West region. So for those of you out in the western part of the country, that number is actually less than what we have here in the South region. I'm going to assume that has something to do with the fact that you guys have more public transportation in the bigger cities and it's a little more remote in certain spots. And take a look at even Seattle. Seattle is even less than the West region, less than what we are here in the South or Miami. I don't necessarily know what all the reasoning behind that is. I don't know if you know that answer, Jason.
Gas taxes, gas itself, and insurance are all cheaper out here.
Okay. Yeah, well, we're in the fraud, here in Florida, we're in the fraud auto insurance capital of the world,
right.
The identity theft capital of the world. So, so for a lot of those reasons, we have a lot higher costs in that regard. So, but that's it. So if you end up owning a car and you operate that car, and these again, the ownership one is the lesser of your loan payment. So if you have a loan payment of $100 a month, that's what you get to take for ownership costs, or $471 if it's more than that. So if your loan payment was $600, you get to take $471 for that car. In regards to the operating costs, you get to take the $220 or whatever number applies to you regardless, and you do not have to document that. Again, just like with the food and maintenance area, the first category we discussed, that is you get to take it regardless of the documentation.
There's a caveat to that. Technically,
okay.
The rule says it's the lesser of your actual expenses or the operating cost amount. However, if you put the operating cost amount, you're very rarely going to get it questioned. But technically, under the rules, it's the lesser of. So just want debt, to be clear.
Right. Yeah. So that is a good point. But like I said, it's, you know, for in the grand scheme of things, $220 or $440 is a good help. But in the overall grand scheme of things, it's really going to probably be a drop in the bucket. But every little bit helps.
And then also,
Okay.
Matt had a question: does a motorcycle count as a vehicle? Yes, it does.
Yes. So go ahead and next slide. We got another polling question here.
All right, all right, all right. Now, this polling question is very special. It is very, very special because the correct answer to the math problem is actually one of the answer choices. This is a very special moment, everybody.
Yeah, it's rare that one has actually a mathematical answer in the one that Jason provides. So, but go ahead and keep your questions coming, and we're going to be going through the form itself here shortly, and you'll kind of see how this starts all kind of coming together. But you know, as I've been saying, that it's very difficult for some people to deal with this. I had a gentleman that I just worked with. Guy barely has 2 nickels to rub together. He's working a second job just to kind of help make ends meet. And at the end of the day, the answer that the revenue officer came back to me says, I'm projecting that he's going to owe $150 a month, and he's going to have to stop doing his $140 a month 401k contribution. Mm-hmm. And so ultimately, at the end of the day, his $150, 140 of it is coming from the fact that of making up that 150. So from a cash perspective, that should actually work for him. But we'll see how that plays out. We're still in the final stage on that.
You know, I got a story about that one. This is one of my earliest cases that I ever worked on after I got my license. Wait, James asked, interested to know if anybody got it wrong. Yes. Well, 9% of people put the wrong answer in, but it doesn't matter.
Yeah.
And George, yeah, I'm not.
As long as they put an answer, that's what matters.
Very funny, George. So one of my earliest cases was a guy that was a Finnish carpenter for luxury homes in the Boulder, Colorado area, and he was kind of basically paid under the table, and it caught up to him. Ended up owing the state and the IRS a bunch of money. Going through his financials, quickly realized where all his money was going. And had to have a very awkward conversation with this gentleman because he was spending several $100s a month on internet pornography. And so, you know, that obviously isn't going to fly with the IRS. And it also is, it's just really awkward to sit there with, you know, to have a conversation with not just the client, but also think about with a revenue officer that's looking over the bank statements too, and you have to explain what all these charges are. Okay, if you've never had that conversation, well, they can get fun. And so we had to explain why he was spending so much money on, you know, this site, this site, this site, this site, and this site, plus all the alcohol that he was buying. You know, liquor store, liquor store, liquor store. So he was spending a few hundred a month on booze and a couple hundred a month on porn. I mean, that's $500 a month or so is what he was blowing. And so had to counsel my client on where to find the free stuff because it's the internet and it's plenty of free stuff out there. And I swear to God, not making this up, he was like, yeah, but I like this. And he went into graphic detail explaining what he liked. And I'm like, you know. And so.
TMI.
Yeah, pretty much. I don't need to know what another dude is into, right? And so we actually had to go through the process of finding him a free source of that particular thing. okay? And then we got him off all the charges. And that freed up money to start making payments to the state of Colorado. But those kind of things are what you're going to find, okay? That's an extreme example, but trust me, you start doing this kind of stuff, you're going to have that conversation about alcohol, about, you know, hey, what are all these ATM withdrawals? Oh, that's for when I go to buy weed because it's legal in my state, right? So, yeah, be ready for some of those really, really awkward conversations. You might be looking at some expenses that they're spending money on that are things that you philosophically disagree with. It gets real fun sometimes. So,
well, you know, just like when you're dealing with people's personal financial information,
yeah.
and I always talk about that, how they just dump their lunch on your desk, so you learn a lot more than you really need to. Anyway, so moving on. So this is the start of a look of what the Form 433A looks like. So as you can see, the first part of the form, we start with the personal information, normal standard stuff, and notice what's the bottom right-hand corner of that. It says the driver's license number in the state. So what is one of the reasons why they want to know that? Anybody want to take a quick guess on that?
Why do they want
section
your DL?
1, lower right-hand corner of the box, they ask for your driver's license in state.
Yeah, throw it in the chat window.
Anybody? Going once, going twice? Okay, well, to confirm your identity, Teresa says. Well, that could be one way, but this is where I'm going to say in general that your driver's license numbers tells you whether obviously you have an active driver's license or not, and it's also connected in your department motor vehicle records, and that's a start of they know how many vehicles you have. So this is one of those things where make sure that as you're going through this, you tell your client that you have to be open and honest with me, because if you don't tell me something and it makes me look bad, it's not going to look good for you. You know, you're trying to be their representative, you're trying to help them to reduce their amounts, and if they don't tell you they have 5 cars or that they have some collectible or something where there's going to be potentially some other record of it, you know, they're out there selling stuff on eBay that can be found, or they've got a court case either for or against them, you know, those are the things they need to be aware of. So that's one of the reasons why that information is there. For Section 2, it's pretty self-explanatory. This is if somebody is employed by another, this is basically W-2 income for this section, not self-employment income. So next slide. Okay, now in Section 3, there lists all these questions, and we're going to go through this, and I'd like for you guys to just pay attention, give me your thoughts on there. I'm going to ask you some questions, but the first question there, question 6, says, are you a party to a lawsuit? And then asks you if you're a plaintiff or defendant. Why? Anybody have any guess as to why they would ask?
I know. Dan, I know.
Not yet, not yet. Have a seat, Horseshack. Anybody have any guess as to why they want to know whether you're a plaintiff or a defendant?
Throw it into the question or chat box there.
Teresa says to determine your ability to pay. Well, that's kind of one wet way. If you're a plaintiff and you're suing somebody, is there a potential for you to get money? Like yesterday, I just met with a woman who, unfortunately, I think it was about 6 years ago, went into apparently for some type of surgery, and there was some kind of malpractice situation that she ended up in, and finally, after 5 years, they ended up selling. So, and yeah, Stuart says whether you receive a settlement or you owe one. That's a good point. So she got $1 million settlement. Well, if she was a tax problem, they want to know that that's the case. So the unfortunate part is if you answer yes to this either way, they're not going to want to go through and process, well, at least if you're in an offer and compromise situation, they're not going to want to process that through. In installment agreement, this is a good thing to know because that could potentially change your ability to pay depending on what kind of program you go into. Now, what about, have you ever filed bankruptcy? What does bankruptcy have anything to do? There's a couple of reasons why we want to know this. Anybody? Teresa seems to be the best one replying to that. So what do you think, Teresa? Why do they want to know if you filed or your client has filed bankruptcy? Anybody? Going once?
I know.
Twice. Some taxes might be protected, Ishmael says. Diane says determine large debts out there. Well, you guys are kind of on the right track, but the big reason why is, can you file again? Chances are that they're not going to, since it's now 10 years before you can refile, then you're obviously not going to be able to discharge the taxes. More than likely, because that is a whole course in and of itself of just talking about bankruptcy and taxes, we really don't go into too much depth, but chances are the person you're dealing with is not going to have dischargeable taxes anyway. And the second reason to know here is this is one of those cases, as we mentioned last week, we talked about the 10-year statute of limitations for collections. This is one of those things that stops the clock. So once a bankruptcy is filed, the IRS is the largest creditor in the world, and so they are stopped from collection while you're in that process. Even if you can't discharge the taxes, they can't come after you during that period of time. Now, if it takes 6 months for that to get through the process, and so the opening and closing of the bankruptcy is 6 months, the bad thing is you add another 6 months to that from the stoppage of the clock. So what basically in that example, you just added another year to how long it takes you to pay off that debt. Now, next question. In the past 10 years, have you lived outside of the U.S. for 6 months or longer? This is one of those situations where, some people, they do that. Whether they go and live somewhere else or they go, they just want to go on a long vacation because they think that they can be hidden. Jason had a friend of his that, told him that that's what he was going to do, and part of the reason he was doing it was, was he going to go to Thailand or something and work over there and just live and hang out?
That was the
Jason?
original plan until I told him about what you're about to say.
Right.
Then
so in this particular
Hawaii.
instance, right, is that if you leave the U.S. for 6 months or longer, again, this is another clock stopper. Not to mention that there's also chances that you could, if you've been out of the country for 6 months or longer, you're in another country, depending on whether you're being an illegal immigrant in another country you're probably applied for a visa, having ability to work there, so you have other income, you could potentially have other assets that they may want to be aware of, but again, that's a discussion for later. But the biggest thing is that the clock stops. So in the case of Jason's friend, he was looking at going to Thailand, which is out of the country, and so the clock would stop. But instead, he suggested go to Hawaii, go to the U.S. Virgin Islands, go to any kind of other part of what's considered the United States that the clock doesn't stop. So that's the biggest thing to be aware of there. Now, the next two questions have to do with, are you a beneficiary or a trustee, fiduciary, or of a trust, estate, or life insurance policy? So ultimately here is, do you have anything else that you could possibly be getting? Maybe you have somebody on their deathbed that maybe they see that they're going to be getting some money here, or maybe you have the current ability to withdraw money from a trust or estate, or maybe you're even controlling that money. So they're looking for places that people are hiding the money. Here's one of those things where you need to make sure that you know the answer to these questions from people. I had a gentleman who came to me where his mother had died the year before, and unfortunately we sat down trying to go, he owed the IRS almost $600,000 over the course of about 10 years. and unfortunately his statute of limitations on some of them were still relatively current. So he had at least a good 6-8 years on them, and he inherited $300,000 from his mother. Prior to that, this guy can barely scrape 2 nickels together. But unfortunately, now it's his money, and it's part of, trying to go through an offer and compromise, which, if you will, fortunately they denied, and now he's dealing with some other major medical problems that he's going to end up having to use that money for. So the IRS is going to wish they had accepted it, because we were settling for like $225,000. But at the end of the day, that's money that had he dealt with this before his mother passed away, then that would not have been necessarily a part of the estate. We would have, could have potentially answered that question yes or no, but that's just one of those things you got to be aware of and know what your client has or has access to. Question 10, do you have a safe deposit box? That should be pretty self-explanatory. Is there anything of value? And again, this is one of those things where having something of value is all relative to the person, because there was one, I had a conversation with somebody, I don't know if it was you or not, Jason, but somebody said about a little old lady having a safe deposit box where she had all her important papers there. And that is of value, but unfortunately from the IRS perspective, it wasn't anything of value from their perspective, but they want to know where they have that and where they can find it. Then the last question is, in the past 10 years, have you transferred any assets of less than their full value? So here's where the guy does the quick claim deed on his house. He signs over his car for $1. They're going to see that, guys. They're going to see that, and the unfortunate part is whether you do it to a friend, family member, or it was a third party, they can claw that back and take it back and end up getting, if you have any equity in those assets, getting that from you and or from the person that you ended up selling it to or transferring it to, and that's not going to make things good. So again, this is where you really need to know the answers. So next slide.
Just a real quick comment on the asset
Sure.
transfer. If you have a client that is either for IRS reasons or for any other reason, they have a boat, heavy equipment, a house, a car, even if it's a clunker, any kind of asset of significant value or something that is traceable. There's paperwork attached to it, like a registration or something like that. You double dang sure, make sure you go through the certificate of discharge process if they have a federal tax lien against them, okay? You have to go through that process. If there's a federal tax lien, it covers everything that they own or that they have a right to own in the future, okay? So go through the certificate of discharge process to remove that asset from the tax lien in order to properly sell it. Otherwise there's this clawback in relation to this question right here. And Frankie, even if the transfer had nothing to do with avoiding paying the IRS, doesn't matter. If they owed the government money and there was a transfer of an asset that should have been covered by the federal tax lien, this will come into play.
All right. Okay, thanks, Jason.
Yep.
Now, let's look at the balance sheet. The balance sheet side of things. So we're looking at personal assets. Again, cash is cash. They're looking at personal bank accounts, checking, savings, money market. They're going to look at what kind of investments they have, and even retirement accounts, because they can force you to liquidate. And in many cases, we may want them to do that, because at the end of the day, if that's where the money is and we can make a payment or settle the amount, we may want them to, because again, most of you should know that if you have somebody who takes a retirement distribution and they're under the 59.5, or they don't make any other special rules, that if they take that distribution, it's costing them the tax plus 10% for early withdrawal. If the government goes in and takes it directly, yes, they still have to pay taxes on it, but that will avoid the 10% penalty. So that's one of the reasons why we would want to do that. But yes, retirement accounts do count, stocks and bonds, plus if there's any, many of us do tax returns where we do the business and the individual, and so if you're dealing with an individual person who has a an S corp, a partnership, or a few of those types of entities, you have to consider the business entity and the value of what that is the case. You may even have to get a valuation done on the business to determine that. Any comments on that, Jason?
Nope.
Okay, next slide. Now, here they want to know what kind of available credit you have, what kind of annuities you have, life insurance with cash surrender value. All of these things are going to be potential sources of other income. Now, here's where you're going to recommend, hey, if you've got enough equity in your home, or line of credit or something that you can go borrow on it and pay off the IRS, they're much better off doing that and not having the IRS as a creditor and not having to provide bank statements or whatever depending on how much they owe. But that's one of the reasons why they want to know what kind of available credit and other annuities, life insurance with cash surrender value, those all have a value to it. Okay, next slide. And then continuing on here, now we move to real estate. Now real estate, and I'm going to kind of address a little bit, I forget who it was, somebody earlier asked about what about a house underwater. Well, here in regards to the real estate, one of the things that they're looking for is what equity do you have? And then what debts do you have against those properties? So personal residence, vacation home, if you have a house that's underwater, then that's going to be good from this analysis perspective because there's no equity for the government to ever get. Yes, it's going to be a hindrance to them if they ever decide they want to sell it because you got to go get the lien removed in order to be able to do that. But again, that one is going to depend on the situation for your client, because if it's in the best interest of the government that they get rid of this albatross that's costing them money, then that may be a good reason why they could release the lien so that they could sell the property even if it was a short sale. Or even on the flip side, I have a client, I'm still trying to deal with him, but he's paying $2,200 a month in rent. If he could go buy an equivalent house, he could probably drop his payment to $1,200 to $1,400, and that would be in the best interest of the government in allowing him to go buy a house because he'd be able to free up some cash that he could use toward paying his taxes. But keep in mind that's even inherited houses, partial ownership. So this is one of those things that you got to let people know if they have this. This is it needs to be included, and it's going to be fair game. Next slide. So taking it even further, now we're looking at vehicles, and as we talked, I forget who it was that asked earlier, but in the terms of vehicles, it's owned and leased. Cars, boats, motorcycles, aircraft, ATVs as all-terrain vehicles, PWCs, power watercraft, so jet skis and the like, and trailers. So anything that might be titled in their name, and again, they have their sources and ability to see all of these items, so make sure that, again, your client tells you anything and everything they have, because these are tagged items that are, when they're tagged, the state knows about it, and if the state knows about it, the IRS has access to it. Okay, next slide. Okay, and then when we get to the last part here, talking about the assets, this is where we start getting into a little more detail. Now, there is an exclusion depending on when we're going to look at, say, offer and compromise, that they don't count, furniture and clothing. But if there were collectible furniture or some kind of clothing that's of a higher price value, which then you go through the rest of the list: art, coins, stamps, comic books, guns, antiques, and even intellectual property. So if they have access to, or they wrote songs and they get royalties from it, or they wrote a book that they get royalties from, mining claims. I had that with my wife's family. They had property up in Alabama, north of Tuscaloosa, where they had natural gas on the property. And it was family property, and so they came in and they started mining that, and everybody started getting money for that. And so her grandparents were the ones that were getting it. Now that they passed away, it was, it's their kids that get it, and so on and so forth. So those things do have a value. Don't underestimate guns. Jason, I remember him telling me a story about he had a guy who had a World War II gun that in a fixed working condition, Jason, was it like $50,000, did you say that was worth?
Yeah.
Yeah, and he had a broken one, and even in a broken condition, it was still worth, I believe you said it was like $20,000.
Exactly.
So those are things that can unfortunately go against the taxpayers. And again, guns have to be registered. I'm assuming that even though it was a non-functioning World War II gun, it still has to be registered in some form or fashion. If you've got somebody who's selling comic books or stamps on eBay, or there's ways that they can find these things. So just make sure that you know the answers to the questions here. So go ahead and go to the next slide.
I want to address some questions real quick.
Okay, sure. Go ahead.
Rich asked, what if they spend significant amounts of their savings to pay off credit cards prior to applying for an offer in compromise? That's going to come back to bite you. Okay, cash is an asset. If you suddenly show a slug of cash disappearing from the bank accounts to pay off unsecured debts, the IRS is not going to be happy. Rich also asked if you're upside down. Go ahead.
No, I was just going to say, and then they can actually ask you to tap that to get the cash back, basically, to pay on the taxes.
Yeah. If you're upside down in a house making payments higher than the monthly standard, are you able to stay higher than the standard? Answer is no. If your mortgage payment or your rent is higher than the local housing standard, you're capped at the maximum unless there's some extenuating circumstances. Okay. Does the IRS ever do drive-bys? Yes. As a matter of fact, for a offer in compromise on an active business, even if there's no field revenue officer assigned, the offer in compromise unit will send an RO to do a field visit to verify assets. It's a requirement for OIC applications on active businesses. Okay. If a revenue officer is assigned, then they will almost always do a physical stop at the house. Okay. Make sure you're not hiding a Lamborghini in the garage, or a Cessna parked around somewhere. Okay. James asks, is collectible the key? Yeah, they're looking for collectible assets. That's the whole point of all this. Can't sell an underwater house. Isn't that a reason to go over the standards? No, I got into this business in 2008. So I was a victim of the, not a victim, that's a bad word, a refugee from the real estate crash myself. That's why I went bankrupt. And so I worked on all these kind of cases, 2008, 2009, 2010, people recovering from the real estate crash, people that were underwater on their houses. Too bad, so sad. That alone, the equity you have in your house, the amount of your mortgage payment, that alone is not a reasonable excuse for not paying your taxes. Okay, so no, you're not going to get a lot of sympathy from the earth for that. Cool.
Right.
Hey, look at that. Yeah.
Okay, another polling question.
Oh, this is the best one. Like really the best one.
Yep.
Actually, no, the toad one's No, the toad one's probably the worst.
Yeah.
What do cows
every time you put this one up, I always think of Chick-fil-A and their cows.
Oh yeah.
Although, as a side note, Jason, it's kind of interesting. I actually have a client. The wife was the one who came to me. She's a doctor in a local hospital, but her husband, their name is King, and his name is Steven. So it's kind of funny, seeing that poor guy. He must really get harassed as having that kind of a name. Poor guy. Although I actually also had a Kim Basinger come to me last year, too.
Oh, no kidding.
Unfortunately, she's not the same Kim Basinger as the actress.
Well, if it was, we probably wouldn't have you here with us, would we?
Well, no, I still love my wife. I love her very much. So,
right.
let's see here.
Okay.
What question number are we in, Jason? This is the 4th polling question.
That was number 4.
So you've got to answer at least 3 of them to get the credit here, Edward. So just make sure you've answered 3 of those.
Yeah, for CPAs, let's just go ahead and do the 5th one as well. That way, if CPAs have to jet, we still have material to cover, but we are at the 1.5 CPE hour mark. So if you're a...
I would say, yeah, give us about an extra 10 or 15 minutes, everyone. We just got a little bit more to cover here. But you know, this is all very helpful information for you, as I said, especially in helping you to represent clients here. So go ahead and answer this polling question. We'll put that up. And 2 plus 2, and many of you probably are twitching because the answer isn't on the screen.
Twitch,
I know that.
Twitch.
Yeah. Because you're OCD and you got to have the right answer, and it just feels wrong to put the wrong answer on it. But the point is to say that you're awake and you're actually answering the question.
Yes.
Okay, we got 91% of you. 5, 4, 3, 2, 1. Let's see, and Frankie says he actually had a Frederick Krueger. So that's, yeah, that would have been a little one here as an answer. Now, and one thing I wanted to point out, Jason, that you kind of said earlier is a lot of what we've been talking, I've been talking in terms of individuals. Keep in mind that on the flip side, a lot of the things that we're talking about here apply on the business side of things. The only difference is that you're going to be talking in terms of different types of assets like accounts receivable, office equipment,
right.
General equipment vehicles. You know, if you're dealing with construction, you're talking about dump trucks, some things like that. So just keep in mind that a lot of this translates over. Now, the last section here that we talk about in regards to the Form 433A, and this is how everything that we just kind of talked about and how this kind of comes together. This is generally looked at as the most important section. It's where you actually determine what your client's ability to pay, and at the end of the day, it helps determine the offer, amount for the income as well as your installment agreement payment. So IA is installment agreement, OIC is, again, is offer and compromise. So go ahead and go to the next slide, Jason.
This is basically where the rubber meets the road, especially if they don't have any equity in assets.
Right. So as we put this all together, as you can kind of see, the left-hand column is all of the income. Where is it coming from? Now, the wages is your gross wages from a monthly perspective, any interest and dividends. We'll talk in a couple of minutes about the business income. Do they receive distributions from a K-1, an IRA, pensions, Social Security, child support, alimony? Remember how we talked about that last week, that this total income is not taxable income. It's
Correct.
What is your income? So even if there's VA income or Social Security disability or disability income, it's income. Regardless, it's an inflow of cash. Look at it more from that perspective.
Yeah,
Where's your inflows of... Go ahead.
I was going to say, don't do this form with your tax preparer hat on.
Correct. Yeah, this is where we talked about there are some similarities between a tax return and trying to represent for tax resolution purposes, but you have to know a lot more information, because look at this stuff that we're putting on here. A lot of the stuff on the left-hand column, you guys probably already know most of it. You probably don't know the child support because you never cared about it. It's not taxable. You don't know what their VA benefits unless they just naturally hand it to you and give it to you. And on the right-hand side, how many of those things do you really know about? You might know about their health care costs. You might know, you know, what taxes that they're paying because it's on their W-2. But other than that, this is not something you're going to want to know for a tax return. So this is where you're starting to fill out the answers here, and you're either putting actuals or what the IRS will allow. So if they capped out at, let's say it was $1,800 for a family of 4 for housing and utilities, then if it was totaled to $2,000, you're going to put the $1,800. If they have the ownership cost, there was what the number I said was the 220 for me in my area. Health insurance, out of pocket, court-ordered payments. Maybe they're required to pay alimony or child support. So the left-hand column says, generally it's the wife who is getting it. Always not always the case, but if they get child support or alimony, that's income on their side. Well, the husband, or usually, is the person who's then having to pay for those other court-ordered payments, and so you do that. Now, one thing I wanted to point out here is that line 47, delinquent state or local taxes. I'm, if you will, fortunate enough in a state that we don't deal with state income taxes, at least not on the individual side of things. We do have it for C corporations, but many of you are in a state where there are state income taxes, or even for us here in Florida, like me and my buddy George over in Orlando, that when you have delinquent state taxes, you have, like the guy I mentioned to you about with the twin sons and paying the car insurance, he came from Wisconsin. Well, his problem originated from when he was in the state of Wisconsin. So you have to deal with the state issue before you deal with the federal issue, because with the state, and the IRS will allow you to do that. Deal with the state issue, come back, and then you deal with that because you get that settled. And in my guy's case, he's paying roughly about $100 a month. Well, that's another $100 that I can put there that's going to help knock down the number, because at the end of the day, that number, line 50, that says net difference, whatever that number is what the IRS is expecting you to pay if you're, say, dealing with an installment agreement. And unfortunately, a lot of times that net difference number, you look at your client and tell them that, hey, that's the number, and they're like, I can't even put half of that together, or even a fraction of that together. And that's when you got to try and play with a few things, and that's where I'm going to want to talk about a couple of things at this point. But for example, let's go back to our friend Randy the realtor. Randy is a realtor who he owes taxes, and he's not been making his estimated payments. Well, when we go and talk about that, and one of the things that he needs to be doing is making his estimated payments. So, but Randy has not been making estimated payments. So what do we tell Randy at this point? Well, you say, Randy, go and make a payment. Go and make it tomorrow. Try and make a $500 payment. Now he's made the payment. Now we can include it and say, Randy's going to make, X dollar a month in payment. So let's just say, break it down in a monthly payment. So if he was going to pay $1,500 a quarter, break it down that he's going to pay $500 a month. And that's another number that, again, he's paying the taxes toward the taxes, but one of the aspects that you'll always be, that Jason mentioned last year, and you remember how he said current and compliant. Current and compliant. You have to stay current and compliant. You can't be adding to this, because if you get into an installment agreement and now you owe more money, that's going to terminate your installment agreement. You get into an offer and compromise, you owe more money, then guess what? That offer and compromise is null and void. So that's where you've got to make sure that your client is trying to deal with the past, but also dealing with the future, and that is also a very difficult conversation to have. Make sure that you deal with that. And then, so now let's move on. Now, if you've got a self-employed individual like Randy, Section 6 is going to be for the self-employed. I believe we've got that in the next slide chart, right, Jason? Go ahead and go to that slide. That section, this is for your sole proprietors, Schedule C people. This is where you're going to put all of their income on the left-hand side again, and you're going to put all the expenses to determine the net income. Now, the bottom number there in line 89, net business income, is going to go back into the previous chart that we just showed here, and Jason's pointing out there on line 23. So if that number came to, $5,000 a month on line 89, that's going to go back to what I think was line 23 on the other slide. Okay, so this is where you work with that, and here at the end of the day, what the best thing to do is you're trying to recreate, in a lot of cases, the information. Just submit a profit loss, balance sheet, depreciation report, put that all together, and put the summary numbers on the sheets, and then just put a note in there, reference the reports there that they can see that detail. Now, you're not given the general ledger. You're going to ask depreciation, what does that have to do with anything? Well, the depreciation documents that at least that something was bought, that you spent the cash to buy an item on a particular date, again, as best you can. You have any questions in regards to anything else that I just talked about there for that part, Jason?
Well, it's one of the big problems with businesses, be it a Schedule C business or a 1065, 1120 business, either way. The problem is they don't keep books, right? They're horrible about maintaining their books. And if you run a business, the IRS expects you to maintain proper record keeping. That is just one of the responsibilities of running a business. So by putting together a P&L and a balance sheet, that shows something to a revenue officer, right? This shows, it's a demonstration of, look, we've had a lot of problems in the past, but we're pulling our head out of the sand or wherever else their head was stuck, and we're getting things fixed, and so that we can go off into the light and be good little taxpayers, okay? So by being able to produce a P&L for the first time in, the 20 years that they've operated their business, it's a sign that says, look, I'm trying to do things right. That's one of the biggest reasons why you should do this.
Right. I mean, ultimately, at the end of the day, you're trying to just show that you're trying to be cooperative. You're trying to become a good little taxpayer. You're trying to get right with everything, and just, hopefully as best to wipe the slate clean as can be done. So hopefully, Matt, that kind of helps you. Matt asked a question about what about the self-employed person who pretty much does everything in cash. Mm-hmm. That's where you got to try and train them to not be doing things in the cash on a go-forward basis. And then your job is to do the best you can with what they've got to try and recreate the records. Because when you're saying in cash, I'm assuming it's not going through the bank statement or a bank account at all.
Let me put, there's so many businesses out there that run on cash, right? And there are, and sorry, but if you're in a marijuana state and if you're getting a lot of these people coming to you because all of a sudden for the first time in their life they need to be, legit and do accounting and payroll taxes and all that stuff, okay? Huge problem. Huge problem. I wish I could do a Trump impression and say that. Huge problem. The challenge there is that when you're talking to a revenue officer or a revenue agent, if there's an examination situation, you need to hold your ground on the fact that there's nothing wrong with cash, okay? The regulatory agencies of any sort don't like cash for obvious reasons. But the fact of the matter is that cash is not illegal, all right? Cash is still legal tender, all right? And until that changes, there's absolutely nothing inherently wrong with running a cash-based business. And you'll have revenue officers that will insist up one side and down the other that cash automatically equates to hiding something, okay? And that's not necessarily true. And most of the time it's not true, all right? So there's that stigma about cash. But as long as you can put the records together, you're fine. Also, on the cash side, for the people that don't maintain their books, don't forget about the Cohen rule, okay? Cohen rule, old court case from the 1930s, I think it was, 1934, somewhere around there.
I think that sounds right.
Where a theater guy didn't keep very good records of his travels, and I think he was a playwright or something, and didn't keep expense records. But the court declared, and this still stands as precedent, all these like 80 years later, that reasonable estimation of actual expenses is sufficient, okay? And so if that's what you got to do in order to create this P&L and balance sheet, then do it, okay? Just as long as you document in writing your assumptions and your sources of data. The IRS audit technique guides are a great place to start for that. Okay, and there's an audit technique guide for cash businesses. Okay, it's the
Right.
Cohen rule.
Yeah, Cohan, C-O-H-A-N.
Yeah, A-N. Yeah.
Yeah, H-A-N. So yeah, so that is one of those things where, because I used it on a real estate agent that I have, and since that's a niche I deal with, I was able to go look at other people's tax returns that had income around his threshold of what he had for his 1099 income, and we were able to put normally what reasonable expenses that he had. So that helps with that. And then Jason's going to put up the last polling question here. I'm going to address Eileen's question here. She says, do you complete a 433 whether you are applying for an installment agreement or an offer in compromise? And also, what is the typical timeline allowed for paying a tax debt over time? Okay, briefly, I'm going to say this, Eileen. It's one of those it depends. Yes, for an offer in compromise, you will need a 433, and there's actually a whole separate form just for that in 433A OIC. And in regards to an installment agreement, we'll talk about that next week, so I'll kind of defer a little bit to that. But just suffice it to say that not all installment agreements require a 433. Many will, and a lot of the large dollar cases you will be. And then the typical timeline could be as long as whatever the statute is, or even there's what's called a partial pay installment agreement where you are not going to be able to pay the full balance. So it just depends on facts and circumstances, and unfortunately no two snowflakes are alike, therefore generally no two taxpayers are going to be alike. So and then don't forget to answer your what happens when a frog car breaks down question. If you'd like to get the extra half of credit. So just hang on for a couple more minutes, everyone. We're almost done.
Yeah, we pushed through. We had enough material here to get to the 11:40 a.m. mark almost. So that actually puts us into 100 minutes, which is 2 CPE hours. Woohoo! Also, another thing, Eileen, next week when I talk about installment agreements, for each of the 6 different types of installment agreements, there are different timelines allowed. Be sure to check out our next episode of Tax Resolution Fun Times, because we will be exactly talking about those IA timelines, okay? Let me close the polling question.
You kind of tell we're a little bit nerds for some of this stuff, I guess, everybody.
Kind of.
So anyway,
I'm a geek, and I love it.
Okay. He's a geek, I'm the nerd, I guess. So ultimately here, in conclusion, hopefully you guys understand what the collection financial standards, some of the tricks and tips to use that when you're preparing the Form 433A. Now again, keep in mind the 433A is for individuals, 433B is for business, 433F as in Frank is the short form of the 433A. And generally if you're dealing with a revenue officer, you're going to be using 433A. 433F is when you're dealing with automated collection and it has not been assigned to a local revenue officer. Don't go quoting line numbers and such on a 433A to automated collection, because they've only been trained on the 433F, and they're going to not understand what you're trying to get them. And then I mentioned the 433D is in dog. That's for direct debit, and that will come into play a little bit more next week when we talk about the installment agreement. So hopefully you understand a lot of the documentation. Again, we'll talk about it when we talk about installment agreement. But remember last week Jason made the analogy of the mortgage here. This is the application. Remember how when you file for a mortgage, you fill out an application and then you get the loan. In this case, they've gotten the loan, now they're filing for the application. The 433 is the application in which you're submitting to either get into an installment agreement currently non-collectible, or the separate form for the 433 on the offer and compromise. Okay, and then remember here that in many cases you're still going to run through the 433A, even if it's not necessarily required, because it can help you determine certain things, even if your client might be qualified for an offer and compromise because they owe lesser amounts. So anyway, with that, any other parting comments, any other questions anybody has out there? Now's the time to ask. Any other comments you have, Jason?
I just want to say, when you're doing consultations with clients, even before they hire you, it's not a bad idea to keep copies of this grid. And this is what I used to do. I would just photocopy just this page and of the 433A, because when you're on the phone, you can do basically a back of the envelope version of this to find out where they're going to land, okay? Because most people can give you a ballpark estimate of their wages, what they spend on food, their mortgage payment, their rent, their car payment, all that stuff, right? People can give you a ballpark. And so I would often go through and just fill one of these out. And eventually you reach the point where you've memorized the form and you can just do it on the back of a napkin, right? And you'll memorize the local standards for your area, your region that you represent clients in the most. And I do encourage people to run with the mortgage analogy. It helps you to close sales. Okay, this isn't a marketing webinar, but it helps you to close sales because it gives people a reference point that they can identify with. And when you do that, it makes the sales process easier. And you can say, look, we're going to have to collect financial information. Do you own your own home, or have you, or have you ever applied for a loan, like for a car or anything else? Well, it's very similar, except we're just kind of doing it in arrears. And the interesting thing is if you look at a Form 1003, the Uniform Residential Mortgage Loan Application, the questions and information on it are very similar to what you see on the 433A. Okay, the forms are actually different format, different layout, different order, but the information on the forms is dang near identical. Okay, so the analogy does hold up, and people, when people can say, "Oh yeah, I get it," okay, it makes the conversation and the sales process a lot easier. So I'll just leave you with that.
Right. Yeah. We tend to talk with the acronyms and the technology and the jargon that. That putting something like that in layman's terms for them to understand can be very helpful. So try and talk in those terms, and it does help you in that regard. So, and I'm not seeing any other additional questions at this time, and so unless you got anything else to say, Jason, I will say let's sign off for here, and we'll look forward to talking to everybody next week.
Thanks, Dan, for presenting today. I really appreciate it, and I hope you have a good weekend.
Yes, you too. Everyone, thank you. Have a great weekend. Hopefully you don't work too hard, and we'll see you next Friday. Same time, same channel.
Goodbye, folks.